the machinery is worth of $2 million. Now, as at the day of buying the machinery, $1 in Nigerian currency is 1,500 naira. So $1 to naira is 1,500 naira. Now, if you check it, 1,500 naira times the $2 million of that particular machinery, you will be looking at 3 billion naira. But now they told you that the payment is going to be made in 3 months' time. Remember, $1 as of the day of the transaction is 1.5 for Nigerian currency. And then getting to that 3rd month of making payments, you're seeing that $1 is now 1,700. That your $1 increase to 1,700 is not going to change the fact that you're paying $2 million. So what this means is that in Nigerian currency, you're paying 3.4 billion naira, meaning that there is an increase of 400 million naira. That is an additional exposure to you as a company. And you see that this is caused by uncertainty about the future exchange rates. That is what risk is all about. Now, from our note to say that risk is usually associated with the possibility that things might go wrong, that events might turn out worse than expected, or that something bad might happen. Risk exists whenever a future outcome or future event cannot be predicted with certainty, just as what we explained. As a business person, there's always the mindset that something might go wrong. It might go worse than expected. You want to invest in a new business. It might not give you the expected return you hoped for, but you have to have an open mind that something might go wrong. There may be loss along the way. Maybe in 3-4 years' time, the company would not still make any profits. So this is what we mean by risk. Now, looking at categories of risk, I know this might sound confusing because there's also another categories of risk down the notes. In the ICANN pack, you have categories of risk in 2 sections, where the other side you have market risk, legal risk, and all of that. Now, this category of risk has to do with the outcome. Let's say it's categories of risk by outcome, right? What outcome does the risk produce? That's what this particular session is talking about. What outcome is the risk producing? Now, we have the pure or downside risk, and then we also have speculative risk or two-way risk. Now, from the name pure or downside risk, you can see that it is the possibility that an adverse event might occur and might be worse than expected. This is the risk where there is a possibility that an adverse event might occur. Events might turn out to be worse than expected, but they cannot be better than expected. Now, what does this mean? Now, looking at it from the name downside, down, it means that the possibility is that adverse events, worse events will occur, but you cannot have a better event than expected. Now, look at the example cited here. There may be a safety risk that employees could be injured by an item of machinery. Now, in an organization, maybe a manufacturing company where they have large machinery, large equipment, of course, there is always a safety, precaution that says before you go into this place, wear your helmet. Before you go here, wear your safety shoe. Now, the possibility that adverse events might occur is there, and that is why they are having all these safety precautions. But the expectation that no one will be injured is slim, right? There is possibility that people can get injured, but the level of the injury may not be small. I think there was a particular, I think it was in, I don't know if it's still in the ICANN Park, in CSM it was there then that a particular lady was meant to go into the place like where they normally do their production. So she, thinking that work has closed, she said, I forgot something inside there, let me go and collect it. She was not wearing her helmet. So only for her to go in there, not knowing that some of the machineries have not been put off. The machine grounded her, like her head was chopped off. Now, the organization knows that such risk can take place. They are aware, and that is a pure risk. For people that, I've seen so many cases of people who work where they use cutting machines, their fingers being chopped off. These are pure risk. They know that it will happen. So because the expectation is that no one will be injured, but possibly there will be injury, right? Now, similarly, there might be a risk for a company that key workers will go on strike, and the company will be unable to provide its goods or services to the customers. This is for public firms, right? In private sector, if you try to go on strike, before you come back the next day, another person is sitting on your seat. So for public firms, there is this possibility, like the trade union and all of that, they want to say, we are going on strike, the government needs to do this or do that. Now, the organization knows that, of course, there's possibility that people will want to go on strike. And then when they go on strike, we will not be able to satisfy our customer. So that is a pure risk. Now, when you talk about speculative risk, with the name two-way risk, with the name as it implies, is just like speculation. When you're speculating something, you have in mind two things. It may work, it may not work. I may make profits, I may lose. Just like you want to invest in a share, or you want to buy a company. Somebody is trying to tell you, come and invest in my company, pay so amount. After doing this business, we'll make profits, we'll give you back your profits and your capital. Now, you as a business person, you know that you're just speculating. We could make profit or we could make loss. So when you hear speculative risk with the name, just remember that it has to do with two ways. It could be that the future outcome might be either better or worse than expected. Now, let's say, for instance, an investor in shares is exposed to a speculative risk because the market price of the shares might go up or down. Now, the investor will gain if the price goes up, and he will suffer a loss if the price goes down. Just like people who do forex trading and all of that, and crypto and all of those currency trading. Now, when it goes high, I will sell. And then they see it dropping. They see the value of that particular currency depreciating, dropping, that selling it will also make them to make a loss. They will not even have that capital which they have injected into that business. So that's what speculative risk is all about. It's a two-way risk. And that is what most businesses is all about. Our business risk is either we make profit or we make loss. Now, for example, a company might also invest in development of a new product on the basis of sales and profit forecast. Of course, that's the usual thing. Before any investment is being done, there's usually a forecast. There's usually a cash flow forecast, sales forecast, and all of that to see, okay, in 5 years' time, how much are we going to make? How do we see this particular product in the next 5 years? Now, having made the sales forecast, it's possible that they'll be making profit. They have arranged how many they are going to sell to make profit. But at the end of the day, the actual sales and profits might turn out to be either higher than that which was forecasted or lower than the forecast. And the investment might provide a high return, moderate return, or low return, or even a loss. So that is what we mean by speculative risk, that the future event or outcome might be either better or worse, right? So since this is the case, we now see that businesses have to do what? Manage their risk. Businesses have to manage their risk, knowing fully well that business cannot be completely eliminated. Business cannot stop. Risk must be there, right? So because you know that there must be some level of risk in organizations in order to make profits, then that is why they have to do what? Manage the risk. Now, companies face both pure risk and speculative risk. Pure risk are risks that can often be controlled either by means of internal controls or by insurance. Pure risks are risks that can often be controlled either by means of internal controls or by insurance. This risk might also be called internal control risk or operational risk. The risk that can be controlled internally or by insurance. You know that most organizations, they have insurance policies where they insure, sometimes they insure their machinery, they insure their building, they insure those things so that at any time such risk occur, those insurance companies will have to help them to do what? To get back that property. They'll have to be, because of the premium they have been paying on behalf of that particular building or that particular machine. At any time there is an issue or anytime there is a loss or fire outbreak, the insurance company comes in to do what? To carry the cost. The same with what? Internal controls. Organizations have internal control system where they guide people, they tell you this is the way we work, this is what you need to do before you get to, this is our muster point. Anytime you hear fire alarm, everybody go to so place. Whenever there is close of business, before you leave your office, turn off all your electrical appliances, turn off the sockets and all of that. These are internal control measures, because if peradventure the sockets were not put off and maybe there is a thunder or there is this kind of lightning that sparks up, you discover that the wire may get, catch that lightning and start burning. And imagine such thing happening in the middle of the night where there is nobody around. Before the office opens in the morning, then something might have happened. So that is why they say a pure risk, a risk that can often be controlled either by means of internal control or by insurance. And don't forget that pure risk can also be called internal control risk or operational risk. Speculative risk cannot be avoided because risk must be taken in order to make profits. As a general rule, higher risk should be justified by the expectation of higher profits, although events might turn out worse than expected, and a company needs to decide what level of speculative risk are acceptable. Speculative risks are usually called business risk and might also be called strategic risk or enterprise risk. Now, in a situation where you see any question, you're seeing enterprise risk, they're using enterprise risk, they're using strategic risk, they're using business risk, please know that it is the same thing as speculative risk. Wherever you see enterprise risk or you see strategic risk. Why? Because this is the risk that happens in the course of doing the business, right? Now, as for the organization to continue to function, they cannot just fold their hands and say, we are not going to do this job. We are not going to embark on any trade because there is risk. In fact, let's pull out. Now, for them to continue, they have to, have that mindset that there should be a level of risk that we should be able to take, we should accept, right? Now, and if you're expecting a higher profit, of course, you know that for you to have a higher profit in a particular investment, then the risk is usually higher, right? When they say the higher the risk, the higher the profit, that is true. Because the investment that tends to have a high return usually comes with high risk. So speculative risk is talking about a company that has such risk, being able to know the level of risk to be accepted, the level of risk that is acceptable, the risk appetite of the organization in order to function well. So having said that, we proceed to the nature of risk management. So risk management is essentially about pursuing opportunities while controlling unwanted outcomes, right? Pursuing opportunities, looking out for possible new opportunities, even as you're looking out for opportunities.
Hello, Sasi.
Can you hear me, please?
Yes, your network is oh yeah, we can hear you now.
Okay, can you still see my screen?
Yes, yes, we can see it.
Okay, so I was talking about the nature of risk management, and I said that risk management is about pursuing opportunities while controlling unwanted outcomes. Having known that there are risks involved in business, how do we manage them? That's what risk management tends to address. And I was trying to cite an example that if peradventure an organization wants to open a new branch, either in another state or in another country. Now, there are benefits to look out for. Of course, they are going to make more money, more sales, more market share. And then they have to also look at the risk attached. Remember, this is a new state or a new country. There are going to be regulatory problems, right? The way the laws guiding or governing where they are currently is different from the laws in that particular place they are trying to set their business. So they're going to look at those laws, the regulatory compliances and all the problems. They look at the cash flow, involved. They look at the market risk involved in that area. Now, having looked at all of this, the management will now ask themselves, how do we pursue the opportunity without exposing the company to unacceptable risk? So that is the nature of risk management. Now, who are the people responsible for risk management? That's what we want to look at. We want to look at the people responsible for risk management. Now, according to our code of corporate governance, right, it's a board of directors' responsibility to ensure that the assets of the company are protected. And for them to ensure that the assets of the company is protected, there must be a risk policy governing the organization, which is usually being issued by the board of directors. The same way the board of directors, guide or are in charge of internal audit and internal control. There's what we call audit charter. Now, the audit charter is a formal document that is being given by the board of directors to the internal audit department, specifying everything they need to do, their roles, their responsibilities, how things are meant to be done. That's what is called audit charter. So the same way the board of directors issued that document is the same way the board of directors we do what we specify and give out the risk policy of the organization to those in charge, those they have put in charge, just as we learned in introduction to strategic financial management, where we talked about agency, the agent and the parents. Now, the board of directors, the shareholders, we have to issue that to the agents, which are the managements, right, who are in charge, for them to use it to oversee the running of the business. So when you hear who is solely responsible for the risk management of an organization, it is the board of directors. But then the board of directors have their own roles, while the management, that's the management that have been assigned to head the organization, also have their own responsibility. Now, the Nigerian Stock Exchange Code of Corporate Governance for public companies state that the duties of the board shall include identification of risk, and monitoring of risk management system. These are the duties of the board of directors. Then they also have, it also say that the board may establish a risk management committee to assist it in oversight of the risk profile, risk management framework, and risk reward strategy determined by the board. It's just the same way they have audit committee. Now, the same way audit committee is being established to help the board of directors, to help them to oversee what the internal audit department is doing, whereby the internal audit department, they report directly to the audit committee. Remember that those that are in the members of the audit committee, they are part of the board of directors. The same thing is applicable here. The board of directors may establish a risk management committee to assist in what? In overseeing everything that has to do with the risk profile, the risk management framework, and everything, and then communicate back to the board. This is a duty of the board of directors. Now, the board is also responsible for defining the company's risk policy. Like I said, they will draft their risk policy. Inside their risk policy, you have their risk appetite, you have their risk limits, and you have the strategy by which they intend to attend to every risk. These are being stated in the risk policy, and then they are integrated into the day-to-day operations of the company. That's why in most organizations, they normally do what they call it prep talk, right? They call it risk awareness. So they use that, their risk policy. Sometimes they give it to people after your induction, after you're employed. Those are part of the documents that are being given. Sometimes they send this soft copy, and most employees don't even bother to go and check what is written inside. After all, they have given me the job, right? But inside those particular booklets or soft copies they normally send, you now see the risk policy of the organization, you see their risk appetite. And then sometimes they gather together, they bring out a particular day to come out, call everybody out, and talk about the risk that the company is likely to face and what everybody is meant to do. So that particular book or that particular document is usually drafted by the board of directors. I hope that is clear. Okay, so we'll look at the International Corporate Governance Network, that is ICGN. So their corporate risk oversight guidelines. Now, they issued this guideline in 2010. And one of the things they said is that risk oversight process begins with the board, just like I've explained earlier. It starts with the board of directors. So the board is responsible for deciding the company's risk strategy and business model. It should understand and agree the level of risk that goes with this. It should then have oversight of the implementation by management of a strategic and operational risk management system. So the board of directors oversees the risk processes, oversees the process, who identifies risks, what's the risk we are facing, how are we going to handle it. This is the sole responsibility of the board of directors, right? Now, the management has the responsibility for developing and implementing company's strategic and routine operational risk management system. Why? Because they are the one in the day-to-day running of the business. They see everything that's happening. They are used to the environment. They are used to the business environment, unlike the board of directors who are outside. So now the management, what they do, they try to develop and implement some policies in line with the strategy that have been set by the board. Now, when they develop these strategies, these policies, or these processes, they communicate with the risk management committee where applicable, or they communicate to the board of directors. This is the risk that is applicable to this organization, and these are the ways we think, or we have researched, or these are the ways that we need to do what, to curtail it, to reduce it to the barest minimum. So that is the work of the management, because they are in the business, they are seeing what is going on. Then the shareholders now have the responsibility for assessing the effectiveness of the board in overseeing risk. Now, investors are not themselves responsible for the oversight of risk in the company. This is not the duties of the investors. It is the board of directors that has that responsibility, while the management will do what? Will develop strategies on how to curtail some routine operational risk that they come across on a daily basis. So the ICGN guideline provide guidance on processes for the oversight of corporate risk by the board and within the company, for investor responsibility and for disclosures by a company on its risk management oversight. Currently now, there are so many disclosures that organizations need to add to their financial statements, not just giving figures of their profits or loss and all of that. They also disclose the possible risk they likely face and the ways and methods that they have, draft to ensure that those risks, those corporate risks are being mitigated, are being handled in an organization. So these things are required to be added to the annual report that is being published. Do we have any questions so far? Okay. So we have risk management and internal control. The FRCN here stands for Financial Reporting Council of Nigeria, right? The Code of Corporate Governance says that the board should undertake at least annually a thorough risk assessment covering all aspects of the company's business. I hope we know that there are auditors that their own aspect of audit is just risk. Their own is risk. It's not about auditing the financial statement. They audit the risk. They try to assess the risk that the organization faces in that particular period and in that particular year. So that is why this particular Financial Reporting Council of Nigeria, they are saying that the board of directors should, undertake at least annually, that is once a year at least, a thorough risk assessment covering all aspects of the company's business and ensure that the company's risk management policies and practices are disclosed in the annual report, just as we said. Say that you ensure that everything that has to do with risk should be inspected, should be audited, should be checked. And then they should ensure that the policies of the organization as regards risk and their practices should be disclosed in their annual report so that those that are concerned will have a look at it. It should not be hidden, it should be made open for people to see. Now, this assessment is likely to be carried out by the Risk Management Committee in collaboration with the Audit Committee, which should then report their findings to the full board. This means that the responsibility of the board of directors and management for risk management are the same as responsibility for the system of internal control, right? Now, talking about the responsibility of the risk management is the same thing when you're talking about what the board of directors has to do in terms of internal control. So when we talk about corporate governance, you're going to be looking at the duties of the responsibilities of board of directors. It's yours clearly stated in Code of Corporate Governance. The responsibility of the management was clearly stated. Why? To curtail the agency risk and all of that, agency conflicts. That was the essence. So we proceed. For example, the Tomball guidance stated that in deciding the company's policies with regard to internal control, the board should consider the following. Now, when the board wants to, decide the company's policies with regard to the way they do things, their internal control, their internal environments, their operational risk, they should consider, number one, the nature and the extent of risk the company is facing. They should consider the extent and the category of risk. right? Remember, I mentioned earlier that categories of risk could be by outcome, and I mentioned that it could be by the source. Now, if you're talking about the extent and categories of risk, which it considers as acceptable, now they are going to look at, if you're looking at categories by outcome, is it a speculative risk or is it a pure risk? Are the results or the future events or the occurrence of the event, is it worse than expected? Okay, could it be worse or could it be better? That's when you talk about speculative. Now, talking about the source, is it coming from market risk? Is it coming from legal risk? Is it coming from technological risk? So they look at the extent and categories of which it considers as acceptable for the company to bear, right? They look at the likelihood that the risk will materialize. That is, the event will turn out worse than expected. So when you hear that, when they hear this statement, the risk will materialize, it means that the event will turn out worse than expected. Now, they'll also look at the company's ability to reduce the probability of an adverse event occurring. That's that event that would have resulted to be a worse scenario, like worst case, it's very bad. Now, they try to reduce the probability of such occurrence, such bad states. For the event to get to that bad state, they try to reduce it. They reduce the impact of that adverse event when it occurs. And then they look at the cost of operating the controls relative to the benefits that the company expects to obtain from the control. Now, what does this mean is that if the organization is trying to control a particular risk from occurring, from bringing a high damage, right, from giving an adverse event, if they are trying to control it, they should look at the costs. How much is it going to take us to control this risk? Now, when you look at the cost, what's the benefits that the company is going to get after having controlled this risk? Now, if the cost is higher than the benefit, then it's not worth it. So they tend to look at these things. If you say we should control this risk, now what are we going to benefit from controlling this risk? They tend to look at both. And then, because you cannot be spending 10 million naira to control a risk that the benefits is 2 million. It doesn't worth it. So they look at these things before they consider the policies to adopt. Now, this consideration should apply to strategic risk as well as to operational risk and internal control systems. In the same way, the Nigerian Corporate Governance Code requires that the board of directors maintain a sound system of risk management and carry out a review of effectiveness of the risk management system at least 1 year. Just as we've explained before, they have to review their risk management system. It's just like looking at let's take for instance a bank that have made out their risk management system, draft out how they are going to control the customers' money not to be stolen, not to be missing. Then in 6 months' time, the same people they are protecting from, maybe from fraudsters, they are trying to protect the money from missing into their hands. Now, those people also, they have their own technology. They are trying to, look for more ways to get access to customers' accounts. Now, you discover that in that 6 months' time, a customer comes to the bank and say, I received debit of so amount of money. How? They start investigating. You see that the bank will have to go back to see that, this our system is no longer effective, or we need to do something to ensure that our customers' funds are safe. So they need to carry out a review. They now say at least 1 year, right? But it's recommended to be done twice a year, every 6 months, to be on the safe side. Now, elements of risk management system. These elements are similar to the elements of internal control system. For those of us that are doing audits, you will be used to this. There should be a culture of risk awareness in the organization, right? Now, it's not just, we are told that risk awareness is everybody's business, right? Curtailing risk in organization, everybody just needs to be aware. You just need to know what are the risks facing. Now, imagine you go to collect your water from the water dispenser in the office, and then water spills on the floor. What do you do? Now, some persons will just walk away from that place, just take your water and walk away. Now, that water that spilled will start rolling, moving, and circulating the place. Next person will come, the same thing. You may discover that somebody else may walk in there without being careful, and the floor will slip the person, and somebody falls down and maybe have a very serious injury. So, imbibing the culture of risk awareness in the organization is very much important. And managers and employees should understand the risk appetite of the company, and that excessive risks are not justified in search for higher profits. This is very important. The managers and the employees are meant to understand, just like we have the marketing department, the sales department, their own is, customer wants to buy you, he wants to buy product, he say he will pay so time. They now look at their system. No, we only allow customers to owe for 2 months, that is 60 days. This customer wants to owe for 3 months. Now, they have to now check what is the risk appetite of the organization when it comes to credit risk. The organization says 2 months, and the customer wants 3 months. So you see that has become excessive for them. And then if peradventure, that customer also, they decide to accept that the customer should owe for 3 months and pay, and then the customer fails to meet that particular time that have been given to him or her, you see that it's going to tell on the organization that they may even start disturbing who is the person that so good to this person, or call him, call her. That particular salesperson that initiated that transaction, they will start pressuring the person. So every manager, every employee should understand the risk appetite of the company, understand the kind of business as accountant, understand the risk appetite, and know the kind of investment you will advise the company to venture into after conducting the analysis and then comparing it with the risk appetite of the organization, right? Now, there should be a system and process for identifying, assessing, measuring risk. When risks have been measured, they can be prioritized, and measures for controlling or containing the risk can be made, right? So when there is a system to identify risk, there are some organizations that if you discover anything that is not right, because of the kind of culture they don't have an open culture where you can communicate. That's why some organizations we have they have some paper box, they have some box where you can just go and put in your suggestion or what you find out without your name, right? They'll just go and put it there so that it will not look like this person reported this particular case. So there should be a system in place where if somebody notices something that could cause hazard or could be harmful to the organization, the people can easily identify and talk about it, and then they assess it and being able to quantify the risk so that appropriate measures will be taken to control such risk. The third one says there should be an efficient system of communicating information about risk, like I just explained, efficient system of communicating. There are organizations whereby if there are things you cannot talk about because you are scared of being fired, right? Imagine an accountant is saying that there is an error in the financial statements, and you're trying to tell maybe the finance manager above you and say, Oga, CEO, because you cannot just go and start canceling if you're using a software, or maybe that particular year have been locked in the software so that no adjustment can be made. So you cannot just go and delete something and adjust. You have to seek approval. And then seeking approval from the board say, oh, you are incompetent. You are not the one that did this. And next thing, you're being queried. If time is not taken, you're fired. So when such kind of scenario exists in an organization, people will be afraid to communicate information about transactions or things that could bring about risk to the management or to the board of directors. So there should be an efficient system of communicating such informations. Then lastly, the strategies and risk should be monitored to ensure that strategic objectives are being achieved within acceptable level of risk. So these are the elements of risk management system. Please, does anyone have any question before we proceed? Okay, so we move to categories of risk. Now, these categories of risk talks about the sources of risk. This is where I was explaining earlier that the other one talks about the outcome, where you have pure risk and speculative risk. And this one talks about the sources. Where is the risk coming from? Now, the need to categorize business and strategic risk is crucial for sustainable organizational growth and continuity, right? A risk management system might be based on a categorization of risk. It is when you are able to know the kind of risk your organization is facing that you'll be able to, map out strategies or systems or controls on how to reduce such risk. So the Turnbull reports mentioned the following risks that might be significant. So the first one here is market risk. So this is the risk from changes in market price of key items, such as price of key commodities. So we all know that even in Nigeria, prices of commodities go up and down. Let's use Garri, for instance. Now, there are times you want to go and buy a pint of Garri. They will tell you, I know there was a time we bought it 3,000 something, 3,000. And then currently now you can buy it for as low as 1,002, 1,003, right? The same thing is applicable to every other commodity. You have the palm oil. There are times the palm oil will drop. There are times it will go high. So this is a market risk. The prices can go up or go down, and a company can benefit from a fall in raw material price. Imagine you're producing a particular thing, and then the raw materials needed to produce it, let's say cotton or cocoa, the raw materials needed to produce it, things like cocoa, is even the price falls, you know that when you buy and make that production, you eventually you try to make a huge amount of profit because you bought at a low price. But then when the raw materials are on a very high price, you discover that if time is not taken, you may be having a loss from that, although the prices are usually pushed to the end users. So whatever thing they encounter in the cost of buying that raw material, they normally add it to their product, and the end users will be the one to bear the cost. But also the level of profit they would have made when they bought it at a lower price will not be the level of profit they will make when the materials are on a high price. So that is what we mean by market risk. When the prices of items, raw materials, commodities go up and down, right? Now we have the credit risk. This is the risk of losses from bad debt or delays by customers in the settlement of their debts. Now, in organizations that they may have their of course, so many organizations, they sell their goods on credit. When they have issued their invoice, then when it's time for the customer to pay, as at when due, they will pay. Now, when they have a large number of receivables, we all know receivables, debtors. When they have a large number of receivables, large amounts that they are yet to recover, there's a credit risk, because it's possible. I've seen a scenario where we went to audit a company, and when we're now going through the debtors list, because their financial statement, the receivable was so large. So when we're now going through the debtors list, we saw a particular company owing almost 80% of the total debt. We now inquired for how long. We wrote to the company, nobody responded. We discovered that the company has even shut down. The company ran into bankruptcy. They could not pay back the loan they collected and all of that. The company closed. And then these people are still carrying it in their book that a particular company is owing them so amount of money. So that risk there, the credit risk is there in that organization. They have lost that amount of money. They can't get it back. So what they do is to write it off so that they maintain the real amount that is what they are meant to put in their financial statement. So credit risk also in bank. Most of the banks that normally give people money, the commercial banks, they lend money and all of that for business operation. There is risk that those debtors may not pay, right? There is that risk that they may likely not pay. Imagine somebody is owing, and at the end of the day, you hear that that person that is owing you is no more. The person is no more. The person is dead. That money is gone, right? So it is, you see, in this country now, next of kin don't used to inherit debt. If I'm your next of kin and they come and tell me you are next of kin or so person, the person is that will not concern me. But if you call me as next of kin, this person has 1 million, come and take it. I will call. So what you are explaining here is that credit risk is a risk that comes from losses from bad debts or delays from customers in making payments. Then we have liquidity risk. From the name liquidity, you'll be able to explain that is when an organization is unable to make their payment or settle their liabilities as at when due, right? So it can occur when a company has no money in the bank or is unable to borrow money quickly. There are situations where a company will want to, carry out a particular transaction or a particular business opportunity just comes up, and you are meant to, do some things, some returns and all of that. You discover that the company may not be able to do that as at that particular time, or the company is owing a loan and is unable to pay back. Okay, you intend to borrow from bank and pay. You are unable to do that as at when due. So this company is actually facing a liquidity risk when the company is unable to make payment or settle their liabilities as at when due. Then we have the technological risk. Of course, we know that technology is evolving, advancement in technology and all of that. So there are changes in technology. And then organizations may be prone to that risk of new technology that they will say, oh, let's wait a little. This technology just came up now. Let's allow it a little. Let's wait. Now, at the process of waiting a little, their competitors may have even started using that particular technology, right? Now, the risk is that a competitor that have taken advantage of that new technology will gain higher market share. We start using it, start selling, start gathering customers. Why this one is still checking, should we do or should we not do, right? So this is what technological risk is talking about, a risk that could arise from changes in technology or inadequacy of technological systems in use. Now, when a major technology change occurs, companies might have to make a decision about whether or not to accept the technology. So that's what technological risk talks about. Now we move to legal risk. Legal risk includes regulatory risk, is the risk of losses arising from failure to comply with laws and regulations, right? Or you have even legal actions. There are things that could occur there was a time I know of a particular employee that sued the company where the person was working, the person was relieved of their duty, and looking at the whole thing, the person took the company to court, and the person won the case. You see now, the company lost a huge amount of money because the person claimed damages. The person claimed damages from the organization. So this is a legal risk, loss from legal actions and lawsuits, right? It could be also like regulatory risk when you're not able to meet with the laws and regulations of the organizations, of the country or the environment where you find yourself. This is what we refer to as legal risk. Then we have health, safety, and environmental risk. Health and safety risk are risks to the health and safety of employees, customers, and the general public, right? So there are times that organizations will want to carry out a fumigation exercise in their organization. Now, in that case, most organizations, if they want to carry out such events, they do it on a Friday. They may tell the whole staff, we are not coming to work on Friday. We want to fumigate the organization. We want to fumigate the company, right? Now, they are looking out for the health and safety of the employees. That's the essence of trying to fumigate, to ensure that the environment is conducive, right? Now, also looking at if, let's say, it's an oil company, there's oil spillage in their environment or where they are operating, their ability to ensure that those losses or those spillage does not arise, or putting in place certain things or machineries or people on ground that will ensure that if at all it happens, there are people to handle that immediately. So that is what we mean by health, safety, and environmental risks. So we also have pollution or destruction of non-renewable raw materials. Also, how they dispose their waste. These are health, safety, and environmental risk. So we have reputation risk. Reputation risk is difficult to measure. That is difficult to quantify, right? Because reputation is not something you can feel or something you can touch, right? So it is a risk that a company's reputation with the general public and customers, or the reputation of its products or brand, will suffer damage. Now, most times, environmental risk and reputation risk, they try to work hand in hand. Because when the organization is not able to sort out the environmental pollution or those health and safety of the organization, of the staff, when such employee leaves, like some organization that does not have HMO coverage for their staff, imagine there's something, there's an accident in the organization, in the company, maybe some staff were doing some jobs and something happened. You don't have a particular hospital on standby where you can rush that staff for immediate attention. Now, when people get known, this information gets known to the public, or such employees resign and say, no, these people, they don't care about their staff, the place is not conducive, it brings about reputation risk. People will now see that those people, now leave those people, they don't know how to handle their staff, their environment is always messed up, all of those things. So reputation risk is, usually has to do with how does the general public see you? What do the people say about you? What does the community where your company is situated, what do they say about you? What do they say about your product? Is it a fake product? Don't matter, this one, if you use this thing, look at what will happen to you. If you use this oil on your car, your engine will knock. So these are what reputation risk. So we move to business probity risk. Probity means honesty. So whenever you hear probity, you're talking about honesty and integrity. So business probity risk is the risk of losses from a failure to act in an honest way. The risks from a failure to act in an honest way. Companies in some industries might be exposed to this type of risk. For some products, there might be a large trade in smuggled goods, such as cigarettes and alcohol products. Companies might be tempted to deal with smugglers in order to increase sales of their products. Now, I was in a place and somebody was, making inquiry, trying to find out how do I bring in so thing from so country without paying for this, custom this, without clearing it, how do I bring it in, right? You see, now if such person that is true, this is a dishonest way of bringing this particular product into the country, because they have ways of doing it. Now, this person does not want to pass through the right way, he wants to pass through corner way. Now, if this product comes in and is being held by the custom, is being seized, they will start inquiring, which organization has this product? You see that the organization now is likely to face business probity risk because it did not act in honesty. And you see how all this news circulates. Before you know it, they're reading it on newspaper. So company smuggled so thing and was caught. And you see such kind of thing that is being told about an organization. So the consequences, if any dishonesty or crime is discovered, could be criminal prosecution, could be fined by the government, or loss of reputation with the public. So that is it. That's for business probability risk. Then we have derivative risk. And I know that we know that derivative is a financial contract, right, whose value is derived from the value of price of another underlying item. It could be oil, it could be gold, it could be interest rates, it could be shares, bonds, and other commodities. So this derivative risk is another type of risk that is included in the syllabus. It has not been there. Like I said, when I wrote SFM, I did not see derivative risk. So they include commodity derivative and financial derivative. Now, this when I'm talking about derivative, I'm talking about under risk, right? All this while risk ends in probability, business probability risk. Is reputation risk. So when you have hedging, that's when you are seeing all these derivatives and all of that. But now there's derivative risk in categories of risk. And the first one talks about commodity risk, commodity derivative rather. So commodity derivative are contracts on the price of certain commodities such as oil, wheat, metals, gold, tin, copper, and coffee. Now, derivative contracts are contracts to buy and sell a quantity of commodity at a future date. Take note of that, at a future date, at a fixed price agreed in the contract. Now, suppose an oil company knows that it will sell 1 million barrels of oil in 6 months. Now, the company will be worried. What if the price falls, right? In 6 months' time, what if this price falls? What do we do? So what will they do? They'll say, okay, let us enter into a contract today to sell the oil in 6 months' time at an agreed price. That is what we mean by commodity derivative. They enter into a contract today to sell that particular commodity in future at an agreed price. Now, why do they do this? To protect themselves against adverse fall in that particular price, in the price of that particular commodity. That is what commodity derivative is all about. Now, talking about financial derivative. Financial derivative are contracts on the price of certain financial instruments or market rates, such as foreign exchange rates, interest rates, bond prices, and share prices. Now, let's take an example like our country, Nigeria. Now, you are having an organization, your company operates here, and you need $10 million in 3 months, right? Now, the company is worried that Naira may depreciate. You need $10 million to transact with a foreign country. Now, you're worried that Naira may depreciate. It may lose its value. Naira, price of Naira today may not be the same in 2 or 3 months' time. Now, it enters in, what the company will now do is to enter into a derivative contract to lock in or otherwise manage the exchange rate. That's to lock in that exchange rate, that even if the price goes up or price goes down, this is what we want it to be. It is usually a contract. They normally enter into that contract, and there's a fee also for that contract. They don't just say it with word of mouth, right? There's also a fee attached to it. So if the Naira subsequently depreciates, the derivative may offset the increased Naira cost. So that is what we mean by financial derivative. So derivative instruments include options, futures, and swaps. They can be used to control risk by hedging exposures to price, right? That's the market risk. They hedge the exposure to how much it's going to cost in the future. They try to hedge it so that they will have a particular amount they expect to pay or they expect to make. Now, on the other hand, they can also be used to speculate, right? Derivative can be used to speculate on changes in market price. Could it go up or could it go down? It can be used for speculation, right? I hope we are following. Somebody is raising hand.
Good evening, ma.
Good evening, sir.
Yes, ma. So my question is, I could remember when we wrote, when I wrote my CSME, then So there's one textbook that I use that specify categories of risk, type of risk, then example of financial risk. So because from this note now, adding me the question, I'll say, okay, list and explain type of risk. Which one are we going to write out of these categories?
Okay. Now, when I started the class, it seems you were not here when we started. When I started the class, I mentioned that from the ICANN test, we have two sections that they put categories of risk, where the first one talks about pure risk and speculative risk. And I mentioned that that particular categories of risk talks about the outcome, right? The outcome that that particular event is going to produce. That is how kind of risk it is. And then I now talked about this other side where I said it has to do with causes. Where is the risk coming from, right? Now, in some condition, ICANN will not even be telling you to list because you are professionals. They'll not be telling you to list and explain. They are going to give you scenario. Now, from the scenario they give to you, you'll be able to know the kind of risk they are expecting you to pick out from that scenario. So have it at the back of your mind that talking about categories of risk, we have categories of risk according to their sources, according to how it came about, what gave rise to such risk. That's where you now have all this business probability, technology, legal, and all of that. Then when you talk about the outcome of risk, right, you now talk about the pure risk and the speculative or two-way risk. Do you understand, or have I answered your question?
Yes, yeah, thank you.
All right. Any other question? Okay, so we proceed. We have here concepts in risk management. So there are some concepts we need to understand when it comes to risk management, and one of it is exposure to risk. Now, when a company is exposed to risk, this means that it will suffer a loss if there are unfavorable changes in conditions in the future or unfavorable events occur. Now, what does this mean is that, let's say that, assuming a company has 1 billion naira receivables from customer. Now, it now introduces a credit limit and say that customers' credit limit have changed though. It must be so amount. Please, you cannot exceed this. Now, the risk exposure here is 1 billion naira. Why? Because they've not put any control. They have just seen that people are owing too much. We are allowing people to owe too much. Look at the amount of money outside. We cannot even buy more products. Now, this is their exposure. They are exposed to 1 billion naira risk, right? So before they now put in that control, they have already identified their risk exposure. So when you're talking about risk exposure, you're talking about what the company is likely to suffer, the loss they are likely to suffer if there are unfavorable changes in the conditions or in the terms of agreements they have with a particular customer. And that one of that risks is that those customers that are owing that big amount of money may likely not pay. So it is an exposure to risk. The organizations have to be able to identify what risk they are exposed to. That is what we mean by exposure to risk. Now, for example, if a Nigerian company holds $2 million, it is exposed to a risk of a fall in the value of the dollar against naira, because the naira value of the dollars will fall. Companies need to assess the significance of their exposures to risk. If possible, exposures need to be measured or quantified. So having known that this money we are holding, this is dollars. Now, if peradventure if they want to use it outside the country, fine, because it's still in the same country, currency where they want to use it. But if they don't want to bring it to their functional currency, they want to talk about their home currency now, the currency of Nigeria, that is naira. You discover that the $1 today may be 1,500 or 1,600. Now, when they now want to use that money, it could either fall or it could rise. So if there is a 4, you discover that instead of you having $1 for 1.5, you're having $1 for 300. So that is an exposure to risk. So organizations should be able to identify what kind of risk they are exposed to in order to be able to manage it. Because if you've not even known what risk you're exposed to, what are you now managing? What risk are you now managing? So the next one is residual risk. This is the remaining exposure to a risk after control measures have been put in place. That small one that you say is remaining, that cannot be completely eliminated. Like the example I gave before, a company that is exposed to 1 billion naira receivables from the customers. Now, this is their risk exposed. Now, when they now put control measure and say, okay, there's going to be a credit limit, and then there should be a regular monitoring of receivable. Please, every week, let us see the receivables record. Let's see who are owing so that we follow up on them. You discover that even after all this follow-up, after everything, some customers will comply and keep and start paying as at when due. There is still that customer that will not be able to meet up. So that particular one that is remaining is what we call the residual risk, the remaining credit risk. Maybe out of 1 billion naira, they were able to recover, and they have 5 million or 500 million left. You see that this is the residual risk. This is the remaining exposure to risk after they have implemented their control measure. They have called them, pay your debts, they have, sent mails and all of that. So that particular remaining part of that risk, that exposure that is yet to be attended to, is what we call a residual risk. So companies control the risk they face. Controls cannot eliminate risk completely. Please take note of that. Controls cannot eliminate risk completely as long as the business is still on, except the company have shut down. Nobody is there again. They have even gone to NRS. We are no longer in business. That is when you say that they can no longer face risk. Risk have been eliminated. But as long as the company is still carrying on the day-to-day activity, there is possibilities of risks, because risk cannot be completely eliminated. And even after taking suitable control measures to mitigate a risk, there is some remaining risk exposure. So if a residual risk is too high for a company to accept, it should implement additional control measures. If that residual risk, after having implemented all measures and all control measures they have put in place earlier, and they discover that we have been asking people to pay their debts, they have not paid. Up to now, we still have large amount of money. They do what? They have to implement additional control measures. What are the additional control measures we should do in order to ensure that this particular risk is reduced to an acceptable level? So that's what we mean by residual risk. So we move to risk appetite. Risk appetite is concerned with how much risk management are willing to take. What's the risk level? How much risk do they want to take? Management might be willing to accept the risk of loss up to a certain maximum limit, right? You tell them, that particular business we did, though, we had a loss of 10 million. They are good with that. But once you proceed to go and say the loss of 50 million, you're breaking somebody's heart, because that is people's investment. So managements have a particular, level of maximum of risk, right? They want to take. And if the chance of making profit is sufficiently attractive to them, that is, if the chance of making profit, though, before you tell them that, okay, if we are to take this business, this is the possibility that we are going to do this. Our risk could be 30 million, it could be 40 million. But if peradventure we hit our target, we'll be making 100 million. You see that they will want to smile. They'll say, okay, let's give it a try. So first, we have to understand the risk appetite of the management. So the risk appetite is used to describe how willing a board is to take on risk. A board of directors might also have an appetite for one type of risk, but an aversion to a different type of risk. Just like we have different type of risks, these different categories. They may want to take, let me accept technological risk, but they don't want to take credit risk. No, people should not. I don't want that credit risk. People should be able to pay as at when due, right? So the risk appetite of a board of or management in a particular situation will depend on the nature and importance of that decision they want to make. The nature and amount of potential gain or loss is very important. How much are we looking at? How much gain are we looking at? What's the loss, expected loss? This is one of the things they look out for in order to now say, okay, this is what we are going for. Then the reliability of the information available to help the board or management to make their decision. Imagine they are trying to invest in a company or they are trying to acquire a new company. What's the reliability of the information available? The financial statement that was published was who audited it. They try to look at the audit firm are they Big Fours? They want to look at the particular audit firm that audited that particular organization before they now say, okay, we can rely on the information of these auditors in order to make our decisions. So that is that for risk appetites. Do we have any question? Okay. So we move to the dynamic nature of risk assessment. Organizations differ in how exposed they are to changes in internal and external risk. Now, the internal and external factors that affect an organization might be very changeable. This means that the risk faced by a company do not remain static, but change over time and in different situations. So there is no organization that will tell you that there is one particular risk they have been facing, is the same level of risk they have been facing since they started business. There are times the risk will change, right? Even the way the risks will come up, it will look like we've never been in business. They will become confused. How did this come about? After all the analysis, after all forecasting, after all market survey, you still discover that something bad will likely occur that we put everybody on suspense. So it's still that risk is not static. The risks that organizations will face do not remain static. They change over time. Just like in the banking sectors, that everything is online, your mobile app and everything. They are trying their IT session, they are trying as much as possible to protect and safeguard people's funds. And there are still other set of people somewhere trying their own best, manipulating their own system to see a way they can hack into the system, right? Just like we have the CAC, there was a time the CAC portal something happened to it. But right now, they have now brought out a different kind of measures in order to do what? To protect the system. So you see that they don't need to remain static. They change as the risk they face change. So they bring out systems and controls in different situations to handle a peculiar matter, a peculiar risk. So it's not static. They don't say this is the way we used to do it right from time. There is need for change as different kind of risk evolve. Some organizations face very changeable risk, while those faced by other companies are relatively stable. It is important to note that even static environments might change unexpectedly. That environment that looks static might change unexpectedly, and organizations' risk management approach must meet the demands posed by the complexity of the risk that it faces. So failure to respond appropriately to risk could lead to failure of organization's strategy or even of the organization itself. So when they are not able to respond to a particular risk they are facing appropriately, you discover that the company itself might fail. There may be a huge loss on the organization that they may find it difficult to stand back, or their strategy, their organizational strategy could also fail, right? Now, it follows from this that organizations in more dynamic environments need a greater investment in risk management strategies. They need a greater investment, so they need to invest more on risk management strategies. Then we have a risk-based approach. The term risk-based approach is often used to describe risk management processes. It is an approach to decision-making based on a detailed evaluation of risk and exposures. When you talk about risk-based approach, you're talking about a detailed evaluation, right? It has to do with after having made those detailed evaluation and of risk of the exposure that the organization is likely to face, what is the approach to attend to them? What is the approach to make decisions based on what we have seen, based on our detailed evaluation of risk? That is what we call risk-based approach. The approach of decision making based on the risk that the organization is exposed to, right? So when you hear risk management approach, you're talking about that's the approach that organization make their decision, and that decision they make is based on their detailed evaluation of their risk that they are exposed to, and the policy guidelines on the level of risk that is acceptable. That is their risk appetite. So these are the things that guide them on how to make decision, on the approach to carry out some business transactions based on the fact that they have evaluated their risk and risk exposures, and they now know their level of the level of risk that is acceptable. That is, they now know their risk appetite. So that is what we mean by risk-based approach. So the risk-based approach takes the view that some risk must be accepted, but risk exposure should be kept within acceptable limits. Decisions should therefore be based on a consideration of both expected benefit and risk. This risk that we are about to accept, it should be within acceptable limits. It should not cross our appetite, should not cross the limits we have set. Just as companies set materiality in audits, we talk about materiality. Organizations set their materiality, they set the level of materiality. You say, okay, when it's 5% of our turnover, then it is material to us. Now, that your 5% for company A, 5% of turnover could be 5 million. Now, for company B, that 5 million could be insignificant to them. They may not see it as what? As material. So it's the same thing applicable here, right? So it depends on the acceptable limits that the organization has put in place, and say, when is so amount accept, but when is more than this, we will not accept. So organization sets that limit. They put it in place for everyone to be aware. So we proceed to identification, assessment, and measurement of risk. So talking about risk identification. Risk identification is the initial stage in a system of risk management. A company needs to understand what risk it faces, right? Both in its environment and its markets. That is the business risk or strategic risk, and then operational risk. So they need to understand what are the risks that we are likely to face. It is when they are able to understand the risks they are likely to face, they will not be able to assess and measure it, right? So many large companies set up risk committees to identify risk. These are committees of managers from different departments or functions. Each committee is responsible for reporting on a particular category of risk or risk in a particular geographical area or of company's operation. So the risk committee could have somebody from maybe finance manager, it could have chief operations manager, it could be the marketing manager. They could come together to form the risk committee, right? Whereby these people in the marketing will identify the risks that will likely face them. The finance will identify the risks that will likely face them. When all these risks are being identified, they will not be able to be assessed and measured in an organization. So risk identification is the first stage. Each committee is responsible for reporting on their particular kind of risk, as I read earlier. Now, it is also good to understand the impact of risk on stakeholders. Like we have talked about before, the stakeholder groups in an organization. So there are risks facing each and every one of them. The employees have their own risk, right? Now, they have several risks they face. The risk could be loss of a job, the threat to health or safety in the work they do. Now, if an employee, like some of these people that work in gas plants that the LPG, that is the cooking gas we use. Those people that sells it, that puts it into our cylinders, that is a health threatening job, right? Now, organizations usually, I think I've seen some of the organizations, they buy cartons of team milk, to help those people that after they do the job, they go and carry those team milk and drink and all of that. So you see that this is a threat to health or safety in the work that these people are doing. Imagine inhaling that gas and all of that. And again, their phone is not even supposed to be there with them, so that it will not cause war. Maybe their phone will ring and try to pick, and all, before you know it, there's an explosion. So this is a threat to health and safety in the work those people do, right? So employees face risk in organization. Even employment benefits might be threatened. There may be time where the particular amount a company expects to get, or the particular turnover, or the particular profits they wanted to make, they planned or they forecasted to make, is not what they achieved at the end of the year. You see that some of the benefits that employees get. I've seen an organization that withdrew some benefits, like benefits of maybe you want to get married, you want to do your child education. There will be no form of support from the organization, because the organization said our profits have declined, our sales have declined, we can no longer meet up with these things. You see that the employee benefits have been threatened. So these are the risks that employees can face in an organization. It's also good that we know that the risk appetite of some employees might differ from the risk appetite of the company and the board's policy on risk. Of course, employees' risk must be different, risk appetite must be different from the one of the board, because the employees have what they are looking out for, right? They are looking out for a good pay, they are looking out for good work environment. So it might differ from the risk appetite of the company. So when employee they have planned, by December, they are going to give us at least bonus, Christmas bonus, maybe 100,000. And then you come by month of November, when they have already budgeted that they are 200,000, 100,000. You're telling them by November that, sorry, this year, everybody will have to bear with us. There will be some employees will not, after that December, you will not see them again. You will not see them again. Right? So risk appetite of some employees is different, might differ from that of the company and their boss policy on risk. So we move to investors. When investors buy shares of a company, they have some expectations of the sort of company it is and the returns they might be expected from their investment. So the board of directors should try to ensure that the risk appetite of the company is consistent with the risk appetite of shareholders. As you're making your mapping out, you're profiling your risk, you're saying this is a risk appetite, will take risks up to this level, up to this amount. Now, in making that decision, in making that, trying to map up that strategies of your risk appetite and all of that, the shareholders that invested their money into the business should also be considered. Ensure that the risk appetite of the company is consistent, because investors who invested need returns. Right? So if the company is trying to, invest on certain investment or certain businesses, they should also put into consideration the returns they are going to give to shareholders. You can't keep telling shareholders every year we made a loss. Next year we invested, we made a loss. It's going to scare potential investors away. So the board of directors should keep shareholders informed about significant risk that the company face, so that the investors can assess their own investment risk. That is why these risks are to be stated in the annual report, so that investors can see it and know if it is what they want to go into, right? And not hiding it away from them and then trying to window dress and put everything to look good. So we move to creditors. The main risk a company, creditors and suppliers from companies own is different from companies' own risk, because the company may not be able to pay what they owe, right? The company may not have money to pay their creditors, and then the creditors are now facing this risk that this one that these people are not able to pay us. How are we going to buy more products. And then the company will stop buying goods and services from them. They will not allow you to buy again. As long as you have not paid your previous debt, we can't sell to you on credit again. So you see that this is also a risk that the creditors, as part of stakeholder groups, face in an organization. The organization being unable to pay the debt they owe to their creditors. So we move to communities and the general public. The communities and the general public are exposed to risk from the actions of the company and the failure by companies to control their risk. Risk to the general public could include consequences of the country, of a decline in business activities. Yes, so many companies are facing some decline in their business activities, right? And the profits due to recession, especially when the company is a major employer. You see that the people, the staff, everybody will still have to partake in that downside of the business. And then the health and safety risk from failures by a company to supply goods that meet with health and safety standard. So because of some companies, because of maybe their inability to get maybe the required materials, you see them producing substandard products that could affect the health and safety. Imagine you go and buy a socket to use in your house, a fuse, and immediately you plug your charger, you are seeing a spark. That's a substandard product. It could be from the socket or from the wiring of that particular extension. So you see that there's still risk to the general public. It affects the general public. Risk to the quality of life from environmental pollution due to failure by the company to control its environmental pollution risk. So when organization is unable to control their pollution, their waste product and all of that, then they are risking the quality of life that you can get from the environment. And sometimes some of those things even affect the crops, the products that are being planted around that area because of the way they have polluted the environment, maybe with their waste and their sewage and all of that. So we move to the government. Of course, we know that the government faces risk of so many. There was a time here in Rivers State, some companies moved out from the states, moved out from Rivers State and moved to other states in Nigeria, right? So you see that the state government, as at then, will be having some, some downside. The amount of tax revenue they would have collected from those states, maybe from their payee and all of that, dropped. So you see that government also has the risk they face. So because the companies are source of economic wealth for the country, they create additional economic activity which create extra wealth. So a risk for government is that major companies may decide to invest in different countries and move their operations from one country to the other. So when so many countries, especially those ones that pay huge amount, maybe their CIT is running to 15, 20 million. Imagine that kind of company moving out from the country, moving out from Nigeria, we see that amount of tax will no longer be paid to Nigeria. So that's one of the risks that the government face. Now we have the customers. They also face the risk that there could be delays in providing goods and services. This time around that we normally use, so many accounting softwares are now on the cloud, right? There are times that the software may not be able to respond, and you click, they tell you undergoing maintenance. And there are some clients, there are customers on ground waiting for you to process their transactions, process maybe their invoice, and then you're telling them, hold on, that there's system breakdown and all of that. So you see that it's going to make those customers, it's going to also delay them from providing their own goods and services to whoever they intend to attend to because of you. They want to get that product from you and go and deliver to their customer. And from your end, there is a delay. So you see that this is also a risk. Also, customers can also face product safety risk, where the product that is being given to them is a life-threatening, right? It's not good for the health. It's not good for the system. It could also give risk to customers because It is mostly what people eat, that, constantly cause one illness or the other. So these are some of the risks that customers face when they get substandard products or products that are not safe for the body, for the system, or for their vehicle, for their generator, as the case may be, is also what? A risk for customers that use them. So we have the business partners. It could be joint venture, it could be a partnership, as the case may be. So a company in a joint venture might try to dominate decision in order to reduce the risk that the joint venture will not operate in the way that they want to. Now, however, by reducing its exposure to risk in a joint venture, a company will have the risk for the other joint venture partners. Imagine is a joint venture, let's say just 2 companies or 3 companies, joint ventures, and a particular one that's maybe his own shares or he has more control. He's trying to make decisions, trying to dominate and make decisions to his own favor, to their own company own favor, not considering the other risk that those other joint ventures, those other companies will likely face. You're just talking about yourself now, talking about the company A. You don't consider company B and C, that all of you are partnering together in that business. So this is a kind of business, a kind of risk that business partners can face. Risk in partnership can be controlled for all partners to some extent by clear terms in the contract agreement. So that's why there's contract agreements where they have the ratio of risk sharing and profit sharing. Then they should be stated how risk can be, how it can be monitored. What is your performance? What do you do? What do each partner do when such things arise? So that is why they have such agreements, such contract agreements. Do we have any question? Okay, so we proceed. So we have left risk identification. We have moved down to risk assessment, right? And don't forget that risk assessment is the same thing as risk profiling, is the same thing as risk mapping. Anywhere you see risk profiling, risk mapping, risk assessment, they are the same thing. So to assess each risk, it is necessary to consider the likelihood of occurrence, right? The likelihood that losses will occur as a consequence of the risk. And that is why we have, this is the matrix that is usually used to describe this or to explain this. The map is a 2x2 matrix, as we can see, where you have here, you have the high impact, low probability. So it means that the impact, that's the size of loss. When you hear impact, it's talking about the size of loss or the size of how it's going to affect level of harm. Let's say level of harm, the size of loss that particular event is going to cause on the organization. So when it is high impact, meaning the size of loss, and then low probability, that is the likelihood of occurrence. So it's possible that the likelihood of that particular action or that particular event turning out to be adverse is high, the high impact, and then the low probability. Then the probability now is low, the impact, the size of the loss is going to give to us is high. Then the probability that it will happen is low. Then it says that the company should consider the need for control measures such as insurance. So when the impact is high and the probability of occurrence is low, the organization should consider a control measure, which is what? Such as insurance. Then when the impact is high, that is the size of the loss is high, and the likelihood of occurrence, which is the probability is also high, they should take immediate action to control the risk. There should be immediate action. When the likelihood of occurrence is high and the impact is also high, they should take immediate action. Then we have low impact, low probability. remember, impact, size of loss, the size of loss is low. The probability or the likelihood of occurrence is also low. So the organization should just be reviewing it periodically, to ensure that it's still on that low state, so that it doesn't move from, you don't forget about it and say, oh, we know that one. And before you know it, it moves to high impact or high probability. So there's need to review periodically when it is low impact and low probability. Then when it is low impact and high probability, then the organization should consider the need for control action. I want to give us an instance. You can write because I will be asking you questions from it. Now, let's say that a company has risk A and risk B. Listen attentively. Risk A and risk B. Now, the probability of risk A occurring is 80%. Probability of risk B occurring is 5%. Now, the impact or the potential loss of risk A is 2 million, and the potential loss of risk B is 500 million. Which risk should receive the greater management attention? I need us to talk to me. I said the company has identified risk A and risk B. Now, the probability of risk A occurring is 80%. Probability of risk B occurring is 5%. Now, the potential loss or impact of risk A occurring is 2 million naira, and that of B is 500 million naira. Which risk should receive greater management attention? Okay.
Risk B.
Risk B.
You're going to give me your reason why you say so. Yes, I'm listening, Madam Nneka.
Okay, so the reason is because of the high impact of the
500
money,
million.
the 500 million. Yes,
Right.
that's why.
Mr. Emmanuel, do you have something else to say? You want to change your mind? You can change your mind, though.
I see the same thing, but just like from my own perspective, the way I like, since the probability of occurrence of risk A is 80% and the one of risk B is 5%. Although risk A is high, the probability is high, but the consequence is low. So that's why we go with risk B.
Oh, thank you very much. You've both spoken well. So you see that this particular scenario I gave, right, has to do with low probability, high impact. The B that has probability of 5% and the potential loss is 500 million. And here it says low probability, high impact. That's the first one. Low probability, high impact. Consider the need for control measures such as insurance. So risk B has a low probability of occurrence, but potentially catastrophic, right? The financial consequences is very high, though it has a low probability. If it eventually happens, the company is losing 500 million, and that is huge. So management should therefore consider what appropriate control or a risk transfer mechanism such as insurance. Thank you very much for that. I believe that is understood. Does anyone have any question on that? Okay, so we proceed. So we move to risk measurements or measuring risk. Whenever possible, risk should be measured. Measuring risk means quantifying the risk. Now, if a company estimates that a major customer has 10% probability of defaulting on 100 million naira receivable, right? This customer is owing 100 million, but there's probability that the company has measured that there's probability that this customer may likely have a 10% probability of default. Now, the company will do what? Will now be able to calculate the expected loss that will arise from that particular customer, which is what? That 10% multiplied that by the 100 million that the customer is owing, which is 10 million. So measuring risk is the same thing as doing what? Quantifying the risk. And then when risk is being quantified, it enables the management to establish the level of risk tolerance that they are going to accept, right? It will help them to, establish the level of risk appetite they should have, then help them to prioritize the risk, and then allocate their resources and evaluate whether the cost of control is justified by the expected benefits. Now, from the notes, it said that when risks are quantified, the risk can be managed through setting targets for maximum risk tolerance and measuring actual performance against the targets. So risk measurements can be financial measurements. For example, a measurement of expected loss can be used, ratios can be used for that. Then there's also non-financial, for example, a measurement of expected injuries to employees at work. This one now is not financial, it's not financial, is you look at it to say, how many employees are likely to have injury. Before you say that, you need to know how many employees go to the place of injury. That's the first point. It's not every employee that goes to the warehouse. It's not every employee that goes to the manufacturing area, right? So you'll be able to state that, okay, employees are likely to have this injury. They may not also have, but the likelihood of having injury, somebody may cut the finger, somebody may, one thing or the other, for those of you that work in manufacturing or construction. Now, even if you're an auditor and you are going to any of this construction, they will even tell you to wear safety shoe, helmets, even coming from the gates, they assume that anything can happen. Helmet, a rod can fall from up. Anything can just happen. Like there was one of the times they were constructing some flyover somewhere around, and somebody was just passing and a block fell from up, just an individual just going his normal way, and a block fell down and hit the individual and the person died there. You see that kind of risk. So there's no how these people will tell everybody walking on the road, but all of you carry helmets if you're coming out of your house. But this is one of the things that could happen. Now, however, not all risks can be measured. Where risks are assessed in qualitative terms, risk management decisions become a matter of management judgment. Risk management decision becomes a matter of what? Management judgment. Okay, so we move to prioritizing risk. Now, within a system of risk management, companies need to establish a process for deciding which risks are tolerable and which might need more control measures to reduce the risk. Now, looking at this now, let's say an entity has identified, let's say, 5 risks that they are likely to face. Now, however, they don't have enough resources. Their resources are insufficient to address these 5 risks simultaneously. So what will they do? They will assess the likelihood of the occurrence of this risk, just like these are 2x2 matrices. They will check the likelihood of occurrence. They will check their potential impacts. That's their probability. They check their probability. They check their potential impacts, whether it's the size of loss is going to give to them. They check it. Now they measure the risk or they quantify it where applicable, right? Now, when they are able to do this, they will not be able to check it with what is our risk appetite. After having gone through this, for these 5 risks we have seen, we have analyzed them, we have checked the likelihood of occurrence, we have checked their potential impact. Now, what is our risk impact? Now, our risk appetite. From the risk appetite of the organization, they will not be able to prioritize. They'll be able to prioritize significantly and say, okay, let's attend to this. Let's allocate our resources more to this one. So that is what we mean by what? Prioritization of risk or prioritizing risk. Being able to do what? To assess the likelihood of the occurrence of the risk and their potential impact, measure them, compare them with the appetite, the risk appetite of the organization, and then be able to do what? Allocate resources based on the critical what? Exposures, the ones that are more likely to cause harm to the organization. So deciding on priorities for risk management might be a matter of management judgment. Some companies and non-business entities use formal techniques to help them with prioritization of risk. One such technique is the risk dashboard, right? This is the risk dashboard where you have the red and amber. The red talks about when you see that it is on the red, it means it is a very high risk, right? The red and amber, it's high but not very high. Attention should also be given to it. Then the green and amber talks about moderate risk. The risk is moderate, it's not high, right? While the green talks about that the risk is low. So I would like us to look at a question. Let's look at a question. Let's conclude with a question for today. This question covers what we have done so far. So remember, I know you know that for you to start answering any question, you have to start from the requirements. The requirements will give you a clue so that when you're reading the main question, you'll be able to start with your pencil in the exam hall. You're already underlining the answers to your question. You're already seeing the answers there. But when you go and read the question, you're not reading with understanding. You just go and read, then come back and look at the requirements. You see yourself going back again to go and read question again. So when you read the requirements, as you now know what you are looking at for. As you go back to read the question, the scenario, you are using your pencil. You have already started seeing your answers already. So these are the ways you maximize your time because you don't have enough time in the exam hall. So looking at this now, from the A part, it said that the risk manager has an important role to play in an organization's risk management. They now said, describe the role of the risk manager. Have we gotten to this place? Describe the role of the risk manager, then assess Zachary's lower understanding of his role. Now, we have seen that they want us to describe the role of the risk manager. Now, let's read the question. Who can read the question for us, please? Thank you. Okay, so let me read. Zachary Lawal was appointed as a risk manager at the company a year ago, and he decided that his first task was to examine the risk that faced the company. Remember the requirement A said, describe the role of the risk manager. And this man, the risk manager, has said that he decided that his first task for the job he got is to examine the risk that faced the company. Have you seen one role of the risk manager? So every answer you need to write here is stated on this scenario, right? Now let's proceed. He concluded that the company faced 3 major risks, which he assessed by examining the impact that would occur if the risk were to materialize. You see, he has assessed, there's another one, assessment, risk assessment. He has assessed the risk by examining the impact that would occur if the risk were to materialize. So he assessed risk 1 as being of low potential impact, as even if it's materialized, it would have little effect on the company's strategy. Risk 2 was assessed as being of medium potential impact, while a third risk 3, was assessed as being of a very high potential impact. Now you have seen that from the scenario, he has identified risks. We are talking about the role of the risk manager. The first one, he has examined the risk. The second one, he has identified the 3 major risks, right? Remember that assessing risk is also what a role of a risk manager, or is a responsibility of a risk manager. Now let's proceed. When Zachary realized the potential impact of risk 3 materializing, that is that the impact is going to be of an adverse effect, right? He issued urgent advice to the board.
Hello, Ma.
Can we hear?
Can't hear you.
Okay. She'll join us again. She'll join us soon. Maybe our network.
To the board.
Yes, we can.
Hello, can
We
you
can
hear me?
hear you now.
So sorry. Nigerian network. I'll be my own network. Is it my network? Okay. Who is laughing? Madam Chidima, I need to relocate to your side, though. This is why you're laughing at me. Okay, so okay, so let's proceed. When Zachary realized the potential impact of risk-3 materializing, he issued urgent advice to the board to withdraw from the activity that give rise to risk-3 being incurred. In the advice, he said that the impact of risk-3 was potentially enormous and it would be irresponsible for that goal to continue to bear the risk. Remember, we are looking at describe the role of the risk manager. Now, he has realized the potential of that and he has issued urgent advice to the board. So he has advised the board, that is, he has given a report on the risk that he assessed. So part of the role of a risk manager is also what? Giving a report to the risk committee or to the board of directors. So like I said, that every answer you need in this particular scenario is inside there, just for you to be able to pick them out. And then even if you feel that you are not able to pick the answer and you know the role and responsibility of a risk manager, what you do is to tailor it back to the scenario. Tailor it back to the scenario. When you mention, let's say you talk, say risk identification, number 1, you have to put a short note that Lawal was able to identify 3 major risks, blah, blah, blah. So take back your answer to the scenario so that the examiner will know that, yes, this person really understands what he or she is doing. Remember, you are professionals. They don't expect you to just be giving them cramped questions. They expect you to put down the concept. Okay, let's proceed. The company commercial director, Yemisi Paul, said that Zachary Lawal and his job at Dago were unnecessary and that risk management was very expensive for the benefits achieved. Remember, we talked about it, that when you're talking about risk management system, you should also weigh it, the costs, weigh it with the benefit that the organization is likely to achieve. If the cost is more than the benefit, then there is no point moving with that particular control system. So she said that all the risk managers do is to tell people what can't be done and that they are pessimists by nature, right? They always tell people what is not attainable, what can be done. She said that she wanted to see entrepreneurial risk takers in Dago and not risk managers who she believed tended to discourage enterprise. Zachary replied that it was his job to eliminate all highest risk. You have seen this statement, eliminate all highest risk. Remember, we have learned today that they cannot eliminate all risk, but rather it can be what? It can be minimized to a BRS minimum. That's why we have residual risk. Now, Zachary is saying that his job is to eliminate all highest risk at Dago. He said that all risk was bad and needed to be eliminated if possible. Then he now said, if it couldn't be eliminated, he said it should be minimized, right? So now from this scenario, I've been able to pick out the role of the risk manager. Now they are saying that we should assess Zachary Lawal's understanding of his role. At first, he understood his role by trying to assess the risk that the organization faced, but along the line, he looked like somebody that didn't really grasp the concept because he believed that he should eliminate all the risks, which is incorrect, right? Risk management is not about eliminating every risk. So, and also he did not adequately consider every alternative risk responses like reduction of risk, transfer of risk, and the likes. His own is that the company should just withdraw immediately. He did not put into consideration every other likely strategies or methods that the organization could likely take to curtail or to bring down that particular risk. So in our next class, we'll look at the remaining parts of the question. That is after we have finished up the topic, because we have the TARA framework, we have the ALAP framework, and all of that to look out to, so that we'll draw the curtain to this particular topic. So do we have any question? We can also go home and look at this question again and see how we can write something about it. So if you have any question, you can unmute and speak. Mr. Tyro, are you
All
there?
right. Thank you very much. Thank you very much. Yes, I don't have anywhere to go. I have to be part of the class. Yes. So thank you very much for the insights into the concept, risk management, and control. Yes. So as far as strategic financial management is concerned, risk management is key. Yes, I was going through the ICANN past question. That is my hobby, to always go through the ICANN past question in relation to any topic. And as I was doing my search, I was just seeing risk everywhere. So, but the point is, even when we see risk everywhere, we are going to overcome the risk by passing the exams. So I'm already typing the years where you will see question on this topic. When you go to your ICANN Pathfinder, May 2017, question 6, you will see a question on this topic. And also November 2017, question 7, a question on this topic. Question 6, March, July 2020. Questions 3, March, July 2020. Question on risk management and control. And one thing with risk, I think she's still coming to that. You'll be seeing risk, or she has even mentioned part of it, risk in relation to foreign exchange. Yes. So you'll see question on all those parts. November 2020, question 4. Question 3, November 2021. And November 2023, question 4. November 2025, question 2A. And also there is a question in relation to Islamic finance that I asked us to watch the video, and also the issue of right issue that I made mention of. When you go to November 2018, question 2, you see a question on that. I'll forward these questions I've highlighted to the group so that we'll see. Please try and go through these questions. They are very important because the exam will always be a mix of calculation and theory. So you can make up your marks by understanding these theories and also the calculations. So please do well to always go through them. I've forwarded one during the first class in relation to the theory aspect. We're expected to have gone through all those questions and be able to answer them well. So also in this aspect also, we're expected to go through all these questions, read and be fine with them. So it's not all about calculation. The theory aspect is also important. They know you always concentrate on calculation. So they will always come with a twist to see how well you understand basic concepts. So thank you very much for your time. See you on Saturday.
So someone is raising hand. Madam Chidima.
So that's this case that we saw now about this man. I don't know, maybe you should go back to that. I saw something that I have a different opinion on.
Okay, I'm going there now. Okay. Where?
So he said the last paragraph says Zachary replied that it was his job to eliminate all of the highest risk at that goal. It does not mean that, to me, you said that it meant that he wanted to eliminate all the risk. Yes, risk cannot be entirely eliminated, but I think what this paragraph is meaning is that, like, the ALAP, as low as reasonably possible, like it has to be as low as reasonably possible. So the highest risk is what he's about to eliminate. That's what I think.
Okay, yeah, I understand your point, but the word eliminates is what we are looking at, right? When you talk about eliminating something, you're talking about removing the thing completely from the surface, right? So when he said eliminate all of the highest risk, he should have used reduce, right? Or maybe minimize. But when he said eliminate, it means he wants to remove all the highest risk completely. I don't know if you get the point. So it's the word eliminate that I'm looking at.
Okay. Okay. Thank you.
You're welcome.